Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep. All right, here we go. We got the B team hosting this week. Danny is on a ski vacation, so we're going to do a lot more chart-centric discussion this week. We're going to start off with the mailbag. We've got one review to do. I was going to do a segment comparing SMCI, which has been kind of the leading tech name in this rally, to prior runs from Taser and Tesla, but we ran out of time. And I don't want to do a poor job on it, so I'd rather do an in-depth job on it. So I will probably release a special video for that. Not sure exactly when, because as you know, if you've been listening to our nightly videos, I've been having all kind of problems, and we'll be switching to a different platform this weekend. So no comparison. We will talk about some. The topic with SMCI was, did it have an exhaustion gap and then reversal? But since then it has made another high. But we might be looking at another stock today that had an exhaustion gap, and Ted will get into that when he reviews some of his trades. So we're going to let's take a step back for a minute. Well, nope, let's go to the mailbag first. So we got a Bitcoin has obviously been in the news lately because it's made all-time highs, and we've put it in. They finally created spot ETFs, which means that they should trade along with the price of Bitcoin intraday as the price moves. Before that, all they had was Bitcoin futures ETFs, which would trade in line with the futures, but not necessarily in line with what Bitcoin is actually doing, because those are looking, as the name implies, into the future. What would Bitcoin be doing? So we added to the portfolio, and a listener sent us this email, and I'll read it. It says, 1 minute read, will this ETF make the podcast? No answer expected. Well, Duke, you're getting an answer, and here we start. He says, why would I purchase something I still don't understand? It pays an 11% dividend but has no PE ratio. Price is truth. Should we all have something stupid in our portfolio? Don't have to pay student loans. Great. Should we put it in Bitcoin? That's a shot at what's going on with the administration. And I know Google is building an 800-acre data plant in Allen County. Do they know something we don't? Is Google going to be a bank? The Fed going to contract with tech companies? Paper, plastic, or bits? So pretty clear what side of the Bitcoin argument Duke comes down on, and I'll go with my response. And Danny is much longer winded than I am. I'll go with my shortened response. I said, so reference to pays a dividend but doesn't have a PE. BITO is what he was referring to. That's the actual Bitcoin futures ETF, and it doesn't have a PE because it's not a business. It doesn't have earnings. So if you have no earnings, you have no PE. And as far as the dividend goes, they pay a dividend because when you buy the ETF, that it's not a dollar for dollar because it's investing in futures. So they buy futures. It's at much less because of the leverage, and then they invest the excess cash in income-making instruments. That's how they were able to pay the high dividend the last quarter. I said BITO pays a dividend because they invest excess cash in income instruments. Not sure how it's stupid when it's becoming mainstream. Stupid is running a massive government deficit. So that's my definition of stupid anyway. Google needs data centers to host cloud business customers, and that's just what's going on with Google, with Microsoft, with Amazon, and it's the NVIDIA chips that are driving this drive to AI that anybody savvy and that has an exposure and could take advantage of AI in their business to increase productivity. Massive data centers being built to host the servers, to host these AI applications. So that's what's going on with Google. And then Danny replied, gold doesn't have a PE either, nor do most commodities. Now, if you love it or hate it, Bitcoin is the digital gold now due to being non-divisible, so the theory goes. I, like you, am skeptical. But that is also why we limit our position size to simply another position in the portfolio. We're not going all in or 30+% like gold bugs or Bitcoin fanatics do. This is simply mathematical and making us money, so I won't argue with price being truth. If BITO truth changes, we will be out. We have a sell discipline for every position. That's exactly right. So we switched from BITO to IBIT when the Bitcoin ETFs, the spot Bitcoin ETFs, got released. I'll show a chart here. First, I'll show BITO, since this was the futures and paid the big dividend. Right here, 1/11/2024, this was the date that all the spot Bitcoin ETFs were approved. And it was a classic sell the news event. It gapped up that day, closed at the low, and then went into a sell-off. We were out of BITO before this because we were expecting some crazy volatility, didn't want to get caught in it. So we waited for this to form a bottom, and then it gapped up here on 2/8. This is when we got back into IBIT, and the guys are going to discuss their trades, or one of them will discuss the trade. So this is where we got back in. It ran up, formed a nice little pullback into the 8-day exponential moving average, and then started gapping again. And it made an all-time high. We sold some on the way up as it got extended. It made an all-time high and did a hard reversal, very similar to this day when the futures, or when the spot Bitcoin ETFs came. So we sold the rest on the negative reversal this day. That was on 3/5, and then it gapped back up the next day. And over the last 2 days, we started another small position in this, and we can use the 8-day exponential moving average as a short-term stop. And that will, if it continues to go higher, that will evolve into using the 21 if the 21 gets above our cost basis. So that's an example of how we raise our stops as our positions become profitable. So that's BITO. IBIT is actually what we switched to, and that was after this little flag was formed, and it broke out on this date 2/24, and we switched into IBIT. The charts are very similar. Since this day, we took some off, we added back over the last couple of days. But IBIT has the combination of volume, institutional backing by iShares, and the liquidity that we need to get in and out for our clients. So IBIT, love it or hate it, for us it's just another position. The big thing that's happening with Bitcoin now is that these spot ETFs allow the big institutions that do asset allocation for big clients to start buying a Bitcoin position as an asset allocation, as a separate asset class in these portfolios. And that's really what's driving the big money into these individual Bitcoin ETFs. So that's the mailbag for this week. Next thing we're going to segue to is I'm going to do a quick overview of what's going on with the market. And what we saw today is a little bit of exhaustion. The market, here's the S&P 500. It was extended 4.9% from the 50-day moving average when we opened today, or when we closed yesterday. So overnight, this morning, the non-farm payroll report came out. It was kind of mixed, but it took the futures higher. So we had a mild open. We went from down about 0.2% to up 0.2% at the open, and then I'll go to a 5-minute chart here. The S&P 500 started running higher. Along with this was a lot of the AI tech names like NVIDIA, AMD were running as well, got extremely extended, and Ted's going to talk about the possibility of a exhaustion gap in NVIDIA. What we ended up doing in-house for clients is hedging half of our NVIDIA position on this big negative reversal. But what we're seeing now, the S&P 500, once it gets more extended, more than 5% extended from the 50-day moving average, that's just too far, too fast. And you're seeing it roll over here. This 5130 is a big level. You can see it was the high 2 days ago. It was where we pulled back yesterday. And that's what supporting the low today, this around this 51.30 area. So as long as we hold that, we don't see a need to get more defensive. As I said, we did some offensive selling this morning and trim some of our SSO when it got too extended in Starburst. So that's a little overview of what's going on with the market. It's a bull market. We've been riding this 21-day moving average. I've been saying ride the wave for quite a while, and every pullback has been bought so far. There will be one of these pullbacks that doesn't get bought, and when it does, the first step is to break the 8-day moving average, and then it'll break the 21-day moving average, and that's when we'll certainly get more defensive. And if it breaks there, it'll head for the 50-day moving average, where we would expect support, but it's no guarantee right now. So we went from 4.9 to about 5.3%. Now pulling back intraday, we're 4.2% extended as of 1:30 p.m. Friday afternoon. So that's what's going on with the overall market. We saw a lot of negative reversals in leadership type stocks today that we'll be monitoring for. We've got our stops in place for everything. If they get hit, they'll get sold. Simple as that. So let's move on now. So last fall, Danny and I started discussion after we hired Connor and Ted. They were interns for us during their senior year in college. Once they graduated, they came on board as full-time employees. And we have a series of steps that new people that come on board that want to be portfolio managers take. And the first one is they bring their own accounts in. We've been watching them as interns, how they trade. We've been discussing trades with them and their rules and finalizing rules that once they rolled over, that if they were going to manage money, these were the rules that they would have to follow. They're certainly more aggressive in their individual accounts, being young guys right out of college, than we are for uh, clients that are close to retirement, for example. So what we did is develop a set of rules that combines their styles with our style, and then you can trade your own money, and you're just dealing with your own emotions. But if you're ever going to manage other people's money, it's important that you can manage your emotions and the collective emotions of those people, because we'll hear from them if they're uncomfortable about something. We'll also hear from them if they think we're not invested enough. So they think we're too aggressive. Sometimes they think we're not aggressive enough. So there's a collective set of emotions that you're dealing with when you do what we do at Revere, which is manage individuals' money. Most of our clients, 80% of our accounts are IRA rollovers from when they worked at various employers, or just started IRAs themselves, or Roth IRAs, or 20% are cash accounts. And then we've got tax implications to deal with. But what Danny and I decided to do is we took a page out of William O'Neill's book. He had his money, which was really the firm's money, O'Neill Capital Management and Investors Business Daily, and he had different people that worked there be portfolio managers and managing the people's money according to his CAN-SLIM rules. And if you did well, you got more money. If you did poorly, you were probably asked to do something else with your life. So he had a long history of developing strong portfolio managers following the CAN-SLIM principles. And that's what Danny and I did. We took some of our personal money, set it aside into accounts for Connor and Ted to start trading. They've also got a few family accounts that they're trading. And the bottom line is that it's important to see how people handle managing other people's money. So what we're going to go into today, they were fortunate when we started. We started in the beginning of the third quarter, or the fourth quarter last year. We had a rocky October. The market bottomed at the end of October and then kicked off a very nice bull market with a follow-through day on November 1st and another one on November 2nd. And this kicked off the rally that we're in the progress of riding the wave higher. So what these guys are going to do is talk about their risk management principles. We're going to look through 5 winning trades that they did and 2 losing trades that they did. I'm going to start each one off. They're going to give their risk, basically the way that they approach risk for each trade in a sentence or two, and then we'll get into some of the trades that they did. We'll have Ted started off. And Ted, you've got 5 winners you're going to talk
Yep.
about. But before we do that, I want to bring up SMCI because you got in the managed accounts right at the right time on January 19th when it had a gap up on
Yep.
a pre-announcement of earnings. And you wrote it up. I know you're going to give some of the details, but what I want you to talk about are some of the rules for a Climax
Yep.
top. I know we'll get there when we discuss that, but can you give us a few sentences on what are some of the characteristics of Climax tops and individual growth names
Yeah.
when they're basically just going too far too fast?
Definitely. So the first thing, before even getting to the specific characteristics of a Climax run, you want to see like where the stock overall is in its cycle. And from our like historical studies, we found that leaders after a year to 18 months, so a year and a half, that is usually the time you want to start looking for characteristics of a Climax run or some sort of breakdown below key moving averages. And so if you look at a longer term SMCI chart, this has been an uptrend for at least over 18 months, probably over 2 years. And we recently had a 6-month base that was relatively wide and loose, but because of the preliminary guidance upgrade before earnings, it catalyzed another leg up. And so that's the day I bought it, what Don said on January 19th. And so I wrote it up and I started seeing acceleration in the move. So that's the first thing I wanted, first characteristic, acceleration in a changing character. So if a stock has been trending up in a certain channel against a certain moving average, if it starts breaking above that upper trend line, if you're to draw one, that is one thing I was looking for. Another characteristic is 30 to 80% plus move within 1 to 3 weeks. And that is usually combined with many up days in a row, or 75 like to 80% of up days within in 10 to 15 day period. And with SMCI, you had that. And what really tipped it off for me was SMCI started gapping up, which is what we call exhaustion gaps. So on February 12th, we gapped up. The next day, we put in an inside day. Then on February 14th, we gapped up again. So that's 2 gaps within 3 days. And then on February 15th, we gapped the third time. And that day was the biggest day up on the highest volume ever of this entire stock. And that to me was where I exited. I didn't, obviously, I don't know where the top is, but after seeing so many characteristics come up, I just thought it was a good risk reward bet to let go of my position. Also, additionally, this was, I believe, at that point, 260% above its 200-day moving average. We've found that even 80 to 100% for especially a large cap is pretty much at the maximum of its range, or the area where you want to look for a Climax run. And this was 260% above. And above the 50-day, it was over like almost 150% above its 50-day. So it just had 6 to 8 characteristics I was looking for. And then the next day it gapped up again, but it bearish engulfed on the highest volume ever, on the largest down day ever as well. Obviously now you can see that SMCI ended up making another move higher. And when I get to my trade, I'll talk about how I re-entered it for a second trade after I sold on February 15th.
Yeah, and some of the cursory review that I did with those Tesla and Taser runs, and it happened in Qualcomm too. The first time it looks like it's a Climax run, it kind of takes a second shot at those highs again. Sometimes it falls short, sometimes it gets above, and what we're seeing is SMCI got above again. But with the weakness in the market today, you can see a negative reversal again on SMCI. So do you want to start, we'll set the date for one of your first trades and then we'll go from there?
Yeah. I'm just going to start off with the first couple losers, if that's okay with you, because
Sure.
those are usually pretty boring, because I enter and then I keep my risk tight. So I get out when my stop gets hit. So the first one I wanted to talk about is Nail, the 3x leveraged home builders ETF. And I bought it on January 22nd out of this high type flag.
So we want to, on January 22nd of this year, we'll set the date back to that, and we'll bring up Nail. Now, reminder, we've got the market, the M, in our favor. The market's been in a rally since November 1st, so that's one of the requirements that we have. Nail had a decent run up, and now the date that he bought last bar that we're showing on here, which is January 22nd. So go ahead, Ted.
Yeah. So you can see there's a clearly defined range in this flag, and I bought a 5% position in Nail, and my entry price was 113.41, and I had a stop loss around the 8 and 10 EMA, around that 108, 109 area. And I was risking 25 basis points on the account. And actually, before I start, Don, you talked about like a quick sentence or two about like just risk parameters and risk management rules. For client accounts at Revere, and for myself, I do not take more than a 12.5% position, and that is usually reserved for the best of the best names, like the NVIDIAs, the SMCIs, the AMDs. And my initial risk on total equity cannot exceed more than 75 basis points. And looking back on all my trades since we started client accounts, I don't think I've exceeded more than 65. And far majority, probably 95% of the trades, I did not exceed more than 50 basis points of initial risk. So those are
so what you're saying, so 50 basis points is 0.5% of the total account value.
Yeah. Yes. Yeah.
Good. Okay. So here's the day where we bought out, where you did the first trade. You just want me to start going forward, or is there a particular date you want me to go to?
Yeah. So
I'm just going to go forward. So tough first day on this.
So yeah, exactly, and that's where I stopped out. So like, I think one of the home builders reported earnings, and that just collapsed the entire sector or industry group. So I pretty much just stopped out right at the open because it gapped down, and I don't really want to, like, after a great first day, you don't really want to see those lows get taken out. And because it was also catalyzed by an event, I just stepped aside immediately at around like just under 110. So it was before my stop loss, but I cut it quick, and then I avoided just like a choppy period for the next month, and definitely avoided another 15% decline. So
let's fast
the loser
to
my
today,
first,
right? So here's where
we
you
are higher
initially
now.
bought it. Yep, we're higher now. When we sell something that doesn't come off of our list, we're always monitoring, but you just don't know how far down the stock's going to go, and that's why we keep our risk defined. All right,
Exactly.
second trade.
Yep, and I just wanted to note one more thing about Nail. It's higher because like the overall market is very strong, and seeing stocks that we sell go higher later on is another like great indicator that we are in a good market. And for example, the 2022 market, if you get stopped out, it is very likely that that thing was probably 15 to 20% lower within a few weeks. So just wanted to add that as well on this Nail trade. And then so the second one is my first entry in AMD, and I stopped out for a quick loss. And then right after this, I'll get on to how I re-entered the stock to get back on the trend.
All right,
so can you go to
set to
February? Yeah, February 15th.
So here's February 15th, 2024, weeks ago. AMD had just broken above this 150 level a couple of weeks prior. So take it away.
So looking back, like doing some post-trade analysis, the ideal entry obviously was, well, in hindsight, was the day before I entered. So February 14th, using the highs of that oops reversal of February 13th. But it wasn't really extended. It just broke out as down trend line. So I thought I could take an entry there, especially with NVIDIA and SMCI acting really well. So what I did was I took a 10% position at 179.7, which at the time was near the highs of the day on that day, with a stop of 173. And that totaled to be a 51 basis point risk on total equity.
Good.
And then if you just to fast forward a few days, I got knocked out on a gap down on AMD on 220. So I got out for about a 50 basis point loss. Yep, right there. I
So
stopped
there's the
out.
220
Yep,
gap down.
yep. So I
Good.
just stepped aside
Take
right
log
there.
on.
Yep. So now if you can go to February 27th.
So there's the prior gap down and stop out, but it repaired
Yep,
itself.
exactly. So we undercut the lows of the base, and then we gapped up right back to the highs of the base. I think that was on NVIDIA earnings. So clearly there's demand for semiconductors, and then it put in these few tight days. And I started accumulating this thing around the 21 exponential moving average on February 27th. And when it pulled back, I used the intraday chart. I'm not sure if you can bring one up, but that's where I kind of took my first 2.5% position at 174 with the lows of that day as my stop, so 172.49. Because I was able to get such a good entry on a pullback setup, I was only risking 2 basis points. So very low risk entry there for me. And then Don, if you to go to the next day, 228. It was another similar situation. If it kind of leaked off earlier in the day, but it caught support, and that's where I added a second buy of 2.5%, doubling it to 5%. That was around 175 with the lows of the first day I took a position on 172.49 with about a 4 basis point risk on total equity. So now in total, I have about 6 basis points risk on total equity, which is very, very low. And that is exactly what I want to get, low risk entry points. So now if you to fast forward just one more day, yep, we broke out of the base, and that's where I more than doubled my position. I added 7.5% AMD over 184. And so now, since I had those earlier entries and then I added at 184, my average cost on AMD was pulled up to 180.26. And I like using whole numbers as stops. And that also kind of coincided with that low of the day, which is also it opens equals low. So I moved my stop up to 180. And since I had a 180.26 average and I moved up my stop to 180, that really just creates asymmetrical leverage because I'm risking 26 cents to potentially make what we'll see in later on multiple dollars and many multiples of risk. So now, Don, if you can fast forward to 3/4, March 4th. So we blasted out on the base on high volume, and then we follow through on another high volume day. And on this third day, we gapped up again, and we kind of faded. So that's where I just took off 20% of my position for 15% gain. And I did this because I oversized, first of all, since I had a 12.5% initial position and I was already at 15%. And my average loss is about 5%. So it was a 3R gain. And in this business, we want to treat it like a business. So when I reach my multiples of risk, I at least take a piece off just to pay myself, just so that I can secure a higher low on the equity curve. And then 2 days later on 3/6, we gapped up again and kind of stalled a little bit. So I just decided to take off another 20% of my position for a 17% gain, which left me with 60% of my original position. And now at this point, I can just hold stress free. So now, Don, can you fast forward to today? And then can you just pull up an intraday too, maybe just to paint a better picture of today's action? So we opened pretty quiet NVIDIA opened on a gap, but AMD decided to follow along with NVIDIA and pushed out for over, I think at the highs, was about 6%, 7% gain on the day. And then we just saw this kind of looks like a Christmas tree up and then back down. And then we end up engulfing yesterday's inside day. So today I took another 33% off of my leftover position. So that's another 20% position. So now I'm left with 40% of my original position. So far, this trade has been a 15% gain on a 12.5% position, which has contributed about 1.9% on total equity. For the rest of the position, I'm watching the 5 EMA, which is not on Don's charts, which also coincides with today's lows. You don't really want to see a gap up, bearish engulfing on extremely high volume shortly after the breakout. And coupled with NVIDIA's action, I'm definitely have my antennas up to protect my profits here. So that's AMD, the first winner I wanted to share.
Good deal. What
Second
date
one,
do you want me to go to for your next? Yeah.
January 19th. So SMCI I kind of already talked about, so I can speed through this one a little bit quicker since I've already given the Climax top characteristics, so I don't have to do that again. I'll just walk through my various trims, and then we can go on to the next one after SMCI. So like I said before, I got in 119 on the gap day. If you to fast forward to 123, so that's where I just decided to take a little bit off just to pay myself, since again I was a little oversized because this was such a powerful mover. So I took off 25% of my position for a 30% gain. Can't really ask for more than that. That's about 6R on my average loss. So then I can hold stress free. And then on February 24th, actually, we made a new high, and looking back, it's hard to time the absolute. It's hard to get perfect sells on everything. So I end up taking just a small extra 10% position off the next day because we made a new high and then kind of fade a little bit on relatively above average volume. And then we fast forward 6 more days to January 30th. I trimmed another 25% off my position because we gapped up and we closed at the lows of the day on very high volume, almost as high as the day we gapped up on. So just trimming little by little on the way up, not letting go of my entire position, and for the most part trailing the EMAs. Kind of what my objective with smaller trims is that I know I'm never going to nail the highs. So I just trust that over time, taking some off into weakness in a move, taking some off into strength, when there's signs of potential exhaustion, overall will end up just averaging to a nice profit at the end, or a nice sell average. Now, if you're to go all the way to 213, at this point, I was up 118% on the position. So I just decided to take another little 15% trim off just to secure more profits. And then the final one was that 215 day where we gapped up on the largest gain, on the largest daily candle, on the highest volume ever. And at 940, I just took off the rest of my position. And then if you to go to present day, actually, and then if you just go one day after, 216, we gapped up again, and then we bearish engulfed on the highest volume ever. And that was a 30% drop in a single day. So obviously in hindsight, I timed it perfectly to avoid that drop. But then if you're to go to the present, I didn't time the top perfectly. And it doesn't really matter for me if I'm timing the top or not. It's just about making more of my winners than I lose all my losers and doing it over and over again. But SMCI, I had a second chance at it. After a couple of weeks, it started getting tight, volume started contracting, and I re-entered on January 3rd with a smaller position, small 5% position.
March 3rd?
In my, oh, sorry. Yeah, March 3rd. And my stop loss was around the 8 EMA, 10 EMA area, risking just 2-3% on the position, which was about like 20-30 basis points. So small risk. And then I got lucky because SMCI announced that its inclusion into the S&P 500. So it gapped up over 20% and then ran for another 10%. And when it was closing near the lows of the day, below the prior highs of 1,077.87, I decided to take 50% off my position there, nailing down 20% gains. And at that point, I was just seeing how extended the market was during my screens. I couldn't really find that many setups. So I thought I just want to backstop this at 1,000, keep it tight, just so I can nail down a profit. I felt already lucky that we got that S&P news. So the next day, I stopped out the rest of my position. And the second trade was a 15% trade overall. The first one, the last sales were at 160% profit, but it totaled up to be about 77% on that first trade. So that's SMCI.
All right. I'm not sure we're going to have time to do 5.
Okay.
Do one more, then we're going to switch to Connor, and we'll
Okay.
come back if we have time, because we've got a hard out
Okay.
today in about 20 minutes.
Okay. Then I'll go over NVIDIA then. I was going to go over NVIDIA, ARM, and IBIT, which is crypto, the Bitcoin ETF, but I'll just go over NVIDIA since this is the number one stock in the market right now, and probably the biggest focus for investors.
What date?
Yeah, January 8th, I believe. Yep. And so this January 8th breakout was a typical base breakout with the volatility contraction pattern within the 6-month base that I've talked about on previous shows. We had a 300% move that preceded this 6-month base. So I was really interested in this name. And when we broke above 500, that's when it took a 12.5% size. Because of the sheer volume it came out on, I pretty much just had my stop just a little bit under 500, pretty much 500, risking 19 basis points. So I got an average about 506 with the stop at 500, risking 19 basis points. And if you can go to 118, that was my first trim. And I took off 15% of my position on 118. And so that was about a 14-15% gain. So once again, about 3R of my average loss, at least since I've started this account. So I want to keep that risk reward ratio going. 15% trim isn't a lot. So I still have 85% of my position. The next day, 124, I decided to take another 15% off of my position. And that was around the 25% mark. So at this point, I have 70% left in my position. The next trim came on January 31st. And I took that off because that was the first. I took 25% off here because it was respecting the 5 EMA this entire way up. And that was the first close below the 5 EMA. So I decided to take another 25% off. And then if you to go to 2.5, on this day, this was a second gap up in a row. So I decided to take off a small 15% once again. And this day was on pretty high volume as well on a second gap. So I thought I would nail down a little more profits. At that point, it was up 38% since my buy point. And then fast forward to 220. This was one of the first signs of weakness after this breakout of just pure strength. We sold off, broke the 5, 8, and 10 EMA and closed below all those moving averages for the first time since the move started. So that's where I took another 15% trim off. And now I was left with about 6%. No, about 3-4%. And I knew that earnings was coming up in 2 days. So that was a comfortable position for me to sit through. And then the next day of significance is February 23rd, the day after earnings. So we gapped up about 60% on earnings after close on that day. And the following day, we gapped up once again and closed at the lows of the day on one of the highest volumes since the move started. That's when I took off another just 7% of my position. And now the final sell was today. Don talked about it in the beginning of the show. We gapped up, and this was the fourth gap in the last 5 days. And then we completely engulfed yesterday's candle. And that's why I decided to just let go of my position. And at this point, the volume is the highest volume since the base breakout. And that is one of the biggest sell signals that I've studied.
So very similar action, very similar rule following to exactly what happened, multiple gaps with SMCI.
Yeah. And just to sum it up, the final trailer, I think I nailed down about 80%, but the total trade with all the trims was about 36% on a 12.5% position.
Excellent.
Those are 3 trades, and if we have time, we can go over the other ones. But Connor's up next.
All right, Connor, let's show your 2 losers first.
All right, we can. Well, first I'll start with the risk. So it's pretty similar. AUM risk is never going to be over 75 basis points, and it can fluctuate between 25 to 75 basis points, but it rarely ever goes over 75 basis points. And more often than not, it's in the ballpark of 25 to 50. And it depends on market. Is the market in an uptrend? Are there favorable sectors, leaders? And is it a liquid stock with earnings and sales? So those are like some of the main drivers in how we determine that. And then, so I tried to find 2 losers that are lower because in this good market, I've gotten stopped out of stuff that's gone much higher. So PDD's the first one. And so you can go to January 9th. So this one stuck out to me like a sore thumb. I saw KWeb and FXI trading at the lows, and then it had a big gap up, and then it started to consolidate. And on January 9th, I bought a 5% position at $149 a share, and I was risking 144 was my stop loss, risking slightly under 25 basis points of AUM. And it started to break out, and it was looking pretty good. It was the best chart in the sector, and it was coming out of that pivot with some volume. And then if you go to January 16th, this had a gap down below the 21-day moving average, and I stopped out at 144 a share for a 4% loss. And if you so it gapped down, it invalidated that breakout, broke the 21, and the sell volume was pretty heavy. And if you fast forward today, the stock's down over 20%. So that just shows you how important stops are, and you can't put your opinion above the market.
Absolutely.
And it's getting crushed lately.
3 out of 4 stocks will follow the trend of the market. This is one of the 4 that isn't.
That's right. And in China as well. They never seem to be too friendly. And then the second loser, you can go to MDB, MongoDB, which, and if you go to February 5th. So on this one, February 5th, I bought a 5% position at 445 a share as it staged this flat base breakout. I had a 425 stop, so I was risking 5% and a 25 basis point AUM risk. And it was looking really good. It was breaking out of the space on volume. And if you go to February 7th, And on February 7th, I added another 5% to the position, and that was at 455. And I raised my stop to 430. It was falling through to the upside, coming out of a big base. The weekly looked fantastic. And then it shot up all the way to 525 a share, but I didn't trim on this one. I was looking for a bigger move as it was coming out of a big base. It had earnings and sales. And then if you go to 221, Don, and this was the day that I got stopped out at 429 a share. It was about a 4% loss. And as it started to come down, I thought it was acting normal. It had big volume on the breakout, and then it came down. I was looking for a retest of the breakout and bounce. And once it violated that breakout spot, broke my stop, I sold that, which was a around a 4% loss. And if you fast forward today, this is lower. It gapped down on earnings yesterday after the close. So glad to be out of that one. And yeah, now it's sitting right at the 200-day major failed breakout.
Yeah,
And
this
then,
is one that, it's in the right sector. It had a great breakout in an uptrending market, and it just didn't work. Plain and
yep,
simple. They just don't all work, and you got to be willing to set aside whatever preconceived notions you have about it and stick to your risk management rules.
exactly. And for winners, you can start with MSTR and go to February 26th. So for MSTR, I bought a 7.5% position on 226, got filled at 720 a share. It had that big move up, and then it formed a flag / cup and handle look, and it shot right up through 720 on huge volume that day. Bitcoin had major momentum, and this has been my favorite stock to play for Bitcoin. They hold a heck of a lot of Bitcoin, and they have quite a small float. So this thing can get moving, but it's important to keep a tight stop on this one because it has a big range. My stop was 666, so it was a 7.5% stop, and AUM risk was 66 basis points. So a little bit more, but for a liquid stock like this in a hot theme, I took a little bit more size. And so it broke out. And then if you fast forward to 3-1, this was my first trim. So it had 3 super powerful days through that 720 pivot. And the position was up 35% in 3 days, and it rejected that 1,000 level and closed below. And I thought that was a good time to take a 25% trim at a 35% gain, and I raised my stop to the low of that gap day. And then this continued to go higher. And if you fast forward to 3-4, this to me looked like an exhaustion candle. It was, 4th or 5th day gapping up in a short period of time. It came into that 13,000 level. There was left side resistance when you zoomed out to the weekly chart. And so at that point, it was 80% gain, and I got filled at 12.90 a share. And if you go to the next day, you can see it moved sharply lower. And another main reason for trimming was that it was around 30 to 35% extended from the 5 EMA. So when a stock moves that quick in this short amount of time, sometimes I think it can just be prudent to take the gains, and it can set up again and you can get back in. So that was MSTR, and it's it's higher again today, but kind of faded back with the market. So that's just a good crypto name to watch when Bitcoin's moving. Another trade we can. Am I going to do 3, Don?
Yeah, make AMD your third one.
Okay, so let's do Eli Lilly. We'll do a non-tech stock. and you can go to January 2nd. Let me find. Yeah, so this Eli Lilly, leader in the GLP-1 and weight loss drugs. So on January 2nd, I bought a 5% position at $589 a share. Stop was at 560, slightly under 5%, and it was a 25 basis points AUM risk. And Don drew that downtrend line and had a really good setup with the 8/21 50-day all coiled up. And then if you go to 1/3, just next day, this followed through immediately, and I doubled the position. I added another 5% on this breakout, raised my stop loss up to 585, which was the 50-day moving average. And I really liked the volume coming into this one, and just being a liquid leader with earnings and sales gave me some more confidence to double that down. And then if you go to 2/6, this was my first trim. It was got filled at $704 a share, and this was on that negative reversal on earnings. I held into earnings. I find enough cushion, and it gapped up and then faded with a kind of an outside reversal candle. So I locked some in at a 25% gain and raised my stop to the 21-day for the rest. And then, if you just go to current day, haven't touched this, still holding. It's coming into 21-day today, and that's my stop for half the position. And then the other half will be a break below 700. This is still acting well. It looks like it's trying to form another base, but for the current position, it's up around 31%. Half will be trailed with the 21 and the rest with the break below 700, which is just a key Livermore level. And then we can do AMD for the last. This one I've kind of traded in and out for quite some time. Do you want to pull up that picture, Don, that I sent you, or start with the market,
Sure.
Smith?
Let's go. Let's go to Market Smith for the buy date. Is it January 2nd? Is that the first date?
For AMD, it was 11/2/2023. Or you want me to talk about the 2024s and then show the 2023s?
Hold on one sec. Yeah, so let's go to 2023 for your first buy.
Okay, so that was.
So this is the day of the second follow-through day. So first follow-through day was on 11/1 for the NASDAQ. On 11/2, we had a subsequent follow-through day on the NASDAQ and a follow-through day on the S&P 500. So this is really what's kicking off the rally. And note
so on that,
how this formed a base during this. This was forming a base. You can see what the market's doing up here. It had 3 legs down. This is the S&P 500 up here, and AMD came down with it, but ended up forming a nice base. So take it away.
Yeah, so on this day, I bought a 10% position at 107.56. You can see that major downtrend line. It gapped up on earnings and kind of formed a flag, so I got in, and it was holding at 100 level and 200-day moving average. So there was a lot of confluence, and the volume came in. My stop was 102.5, so it was a 50 basis points AUM risk. And I liked how it came out on volume. And then if you go to 11/28, I sold this in one piece, and this was partly due to some other leaders in the market weren't acting great. This was a 14% gain, and I took the gain at $122.10 as it was getting a little bit extended. And to be completely honest, as the market started to rally, it was a little bit harder to hold winners because we were so used to just trying to get a nickel and a dime for each trade. So I booked that to finance some other trades. And then if we go to 12/21/2023, this was where I got back in. So I got back in at 139.89. I had $132 stop. It was a 5% risk, about 50 basis points AUM risk, and it broke this flag and then it squatted, but it came down close to my stop. Don, just fast forward like 3 days, or like 4 days actually. Sorry. So yeah, once I bought, it started going nicely, and then it came back down to the 21 day. It was about $1.50 away from my stop, and it was looking a little weak, but I just stuck with my stop there, and it then continued higher on volume, and on 125 this year, I trimmed 25% at a 30% gain as it staged a negative reversal. And this was like 4 hours the initial risk. So I thought it made sense to lock some in at there, still holding a portion of it. And then 229, this is when I added back what I sold there. So I added back what I sold and a little more. This was now an 11% size. And I got filled at 183 a share with 172 stop, which was around the 21 day. And it ballooned up. This was just kind of a textbook consolidation, and it broke out on huge volume. And then 3/6 is the next date. And that's when I trimmed 25% of the position at roughly $210 a share. It was 3-4 days up on a huge breakout. And given I've been holding some from quite lower, some of the shares from lower were at a 40 to 45% gain. So it made sense to lock some in. And now I'm still in AMD, and half of it's with the 21 day. And then the other half is that base low, which is roughly around 160 to 170 a share for the second half. So that's AMD.
Very good. I think we are going to have to wrap it up here. Our producer's got a hard out. So let's just take a quick review of where we are on it. And it is 2:19 Eastern time on Friday. We still have this negative reversal that we're looking at. So we made higher highs, got a little too extended, hard negative reversal. We saw NVIDIA with what looks like a possible exhaustion gap. I'm say possible because, again, we just showed several examples where what looks exhaustive sometimes takes a shot at another high, and that's something I saw in my preliminary investigation with Taser and with Test Qualcomm. So we did a little bit of offensive selling today, did some defensive selling, and tune in Friday night for a portfolio update for Grotection. Connor and Ted, thanks so much for going through those trades. And if Danny was here, I would send it back to him, but instead I'll just imitate his voice, Zach, and then we'll take it home. How's that sound?
Sounds good to
All
me.
right. If you like what you heard, tell your friends, tell your family. Go to revereasset.com. Check out our content. We've got daily videos that Don does. We've got a weekend podcast. And how about joining us back here next week on Your Money? Because it's not about how much you make in the markets. It's about how much of that you can keep.